Hello, and welcome to Rocket Fuel, your daily update of everything that's happening in the Rocket Pool community. My name is Wack. Today is June 6th, and today's episode is going to be talking about tokenomics. We're actually going to do a really deep dive into the public-facing tokenomics explainer that came out yesterday. I'm so excited about it. We're going to be talking about that quite a lot. We're going to be talking about some drama around rewards night and yesterday's rewards period and some ideas that I have about it. We're going to be talking about 1KX, exiting validators and some scariness around that, and an airdrop for Gravita users. So let's get started.
10, 9, ignition sequence start, 6.
Okay, so we're going to be starting with this post from Long for Wisdom that was put in the forum, and it says Tokenomics Rework Update 1, New Explainers. So LFW says, hi all, the core tokenomics contributors wanted to give a brief update on where we're at with the tokenomics work, share some of the new content and lay out some ways which you can help support the effort. Previous threads on the topic can be found here, and then there's a link. It says, so where are we at? It says we've been following the rough steps here for the last couple of weeks, and we've just completed step 3 by explaining the explainer document. So releasing the explainer documents. It says that leaves 2 steps that we're actively working on for the next little while, which seeks feedback from technically skilled or highly engaged community members on the draft specification and make a concerted effort to gather feedback via the forum from the wider community. This is we're moving to a phase dedicated to gathering feedback. We want to confirm the general direction is good, want specifications, and make the high-level explainers as clear as possible. If you'd like to keep track of the progress, this section of RPIP 49 is kept up to date as this to-do list. Make major updates on the forum too. You can subscribe via RSS. So then there's the new tokenomics explainers. So this is in 5 parts, and it's on the tokenomics landing page. We're going to be delving into those in a few minutes. It says the new pages cover the reasoning behind the contents, and tokenomics updates are different levels of depth, while the goal that there's something easy for everyone to engage with regardless of their level of knowledge and available time. Huge thanks to those contributed content and feedback to these documents. So how can you help? You can help by 3 areas. So we want meta feedback on the explainers. So now the explainers are out, we'd love feedback on the actual audience. Is there anything unclear, explained badly, misleading? Does the reading order hold up? Do you have enough of foundation from the previous sections to continue understanding things? Does it feel like a surprise curveball? Is the formatting clear? Could it look prettier, more inviting, etc.? Then there's specification feedback. So they want feedback from technical people or structurally minded members of the community on the RPIP specification sections. Any improvements we can make here to clarify completeness, comprehension will help with the core team. And then there's general content feedback as well. So if you have feedback on the rework itself and its contents, now's the time. If we hear concerns, excitements, and thoughts, we can make this rework as successful as possible for everyone. And then LFW says, on a personal note, wider engagement with this, whether positive or negative, is a huge boost to our motivation. This includes everything from small celebratory comment to a critical essay. It's much nicer to work on something that clearly matters to the community. If you can leave comments in this forum thread and reach us on Discord. So thanks. So then there's some questions to get an idea of where people stand. So it says to help us get a sense of where everyone is. Really appreciate it if you voted in the informal polls below. Note that the results are public so we can cross-reference the responses. So how deep are you in the topics? Have you read the RPIPs? Have you read the deeper explainers? Have you read the surface level explainers or not read anything? So 77% of the responders have read the RPIP drafts, which is really cool. How well do you understand the rework? Maybe I was quite optimistic in my high level of understanding, whereas most people said medium level of understanding. So maybe 77% of people said medium and 23 people said high. And then how do you feel about the rework? And here 59% of people say very positive, 33% of people say fairly excuse me, I don't know where that came from. Yeah, 59% of people say very positive, 33% of people say fairly positive, and 8% of people say neutral. So that's definitely something to look for as well. We've got some comments here. Van Caspel says, I strongly feel that the work has been done here is of high quality and authors deserve praise. And then it says that there's some questions there basically that people can start answering. But yeah, this is absolutely fantastic. So Let's actually dig into the explainers now, because we're going to actually spend a really long time going through each of these. So let me just introduce you to the actual page itself. So this is the RPIPS page, and this is a specific page about the tokenomics rework. So here we have the information overview. These are the explainers. We've got 2 intro level explainers and 3 intermediate level explainers, and 1 is advanced, which is looking at the actual RPIPS. So part 1 is why rework Rocket Pool's tokenomics. Part 2 is introduction to the tokenomics rework. Part 3 is foundation of the tokenomics rework. 4 is supporting components of the tokenomics rework, and 5 is glossary of terms. And then there's content RPIPs if you want to have a look at the different RPIPs that are going into this. And then there's the additional RPIPs about RPL value capture. So the people here who have been involved in this whole process, Valdorf literally has his name on every single one of them, which is amazing. On top of that, we have Long Wisdom, Jasper, Paladin, Samus, and Mike Leach. That's Wonder was involved in the execution, their triggerable exits, but not with the tokenomics work. So this is a really great team of people. Let's actually now start with part 1. Why do we need to rework Rocket Pool's tokenomics? So let's start with the history here. And the first thing, it actually goes all the way back to the Rocket Pool's white paper, which is where the idea of staking ETH, of course, was born. But at the same time, there was this idea of staking RPL with the ETH. After that, Zero wrote his Rocket Pool investment thesis, and he really tied the 2 ideas together and said that the RPL token will get a lot of value from being staked this way. And he said it'll be staked like this and like that, and the value will increase and it'll be really good for everyone, etc. And then what happened was a lot of people bought into that and came into the protocol because of Zero's RPIPs, in Rocket Pool investment thesis. And then after that, FireEyes was tasked with designing the tokenomics, and they really leaned into this needing RPL as a collateral, and that kind of became the protocol basically. And for a while, people thought this was a really good idea. They thought we were tying RPL with Ethereum in a really strong way, really aligned way, and everybody was really happy about it. And of course, as the prices were going up, people thought it was amazing. People thought it was amazing, right? But then let's talk about what the original ideas, what they tried to do. So there's 3 ideals here, and it says ideal 1 was that RPL stake serves the entry ticket to ETH commission by the minimum staking requirement, which was 10% of borrowed ETH. Then the ideal 2 was that the rewards for RPL would be attractive enough that people would maintain this minimum staking level. So we expected people to stay at or above the 10% and adding RPL when they needed to. And the ideal 3 was in the long run, the fundamental value of RPL trends to what's needed for all mini pools to hit this minimum staking level, i.e. the market cap should be 10% of RETH TVL. So these were the 3 kind of ideas that were formed, and the pieces of information that people really leaning into and supporting. Sadly, there were issues in reality. So what happened is that by running a validator, the amount of speculation needed for RPL far outweighs any staking rewards. And then they give an example of this, right? So they say, let's assume there's a validator with the minimum RPL needed. Well, if the RPL is flat, then they get a 9% boost compared to solo staking. If RPL goes down, then they see a 21% drop in their staking rewards. And if RPL goes up, then they see a 40% boost in their solo staking rewards. So the idea here is that your rewards that you get from staking are dependent far more on what's happening to the RPL price than the actual staking rewards itself. As RPL goes up, your rewards increase. As RPL goes down, your rewards drastically decrease. And that means that the people who are staking Rocket Pool are more dependent on the price of RPL than they are about staking itself. Then it says the RPL rewards are not attractive enough for node operators to maintain the minimum. And the evidence they give here is that people have let them sell their collateral go below the minimum amount. Month after month, it's just been getting lower and lower, and people are not topping up. And then there are a couple of charts that are shared here that you can see on the screen. And if you're listening, I'm sorry about that. I'll try to describe them. It basically shows that the median the median staker on Rocket Pool is under collateralized, and the average staker is very lowly collateralized. So much so that in yesterday's rewards period, I think about 70% of node operators on Rocket Pool were under collateralized, so they were not getting any RPL rewards. So that is a really bad experience. Now, with number 3, the ideal that the RPL token will have value at 10% of RETH TVL. Sadly, that's not happening in reality because the problem is people aren't topping up, so it causes issues with that valuation. So here they say, because some node operators aren't topping up per ideal 2, that means a fundamental value calculation ideal 3 breaks. AGF at maturity, if the collateral is 5% of borrowed ETH, then RPL's value would be half the value of a situation that's identical except the average collateral is 10% of borrowed ETH. As shown in figure 1 above, this effect is definitely present. Then they said that RETH TVL is limited. So what happens is it says that first operators that exit some of their mini pools to get back over RPL rewards. And we've seen this happen month after month, right? So as people's collateral level goes below the threshold for them to get RPL rewards, instead of topping up their RPL rewards, what they're doing instead is exiting validators to make sure that the RPL that they have left is still above the threshold. So that's how they're making the money. They're keeping those RPL rewards coming, but they're doing it by exiting validators. And of course, that's terrible for Rocket Pool's TVL and growth. Then they say, second, those who'd like to operate for Rocket Pool but are unwilling to speculate on RPL are simply unable to participate because RPL speculation is built into mini pool operation. And third, this speculation is exacerbated at smaller bond sizes. 10% borrowed ETH requirement forces greater RPL exposure as bond size is reduced. So for 16 ETH, you need 1.6 ETH of RPL. For 8 ETH validator, you need 2.4. For a 4 ETH validator, you need 2.8 ETH of RPL. And then for a 1.5 ETH bond, you need 3.05 ETH of RPL. And that would actually end up being, your validator would end up being 67% RPL, whereas with 16 ETH plus 1.6 ETH, then your validator is 9% RPL. So you're asking for people to add the ways to get the protocol to scale to greater and greater TVL lift amounts. What you're doing is you're asking people to take on exorbitant RPL speculation within that. And then they're finally finishing section 1 by saying that the system is brittle and it's not working. So they said that 10% borrowed ETH minimum is something that the protocol tries to impose upon the market, but it fails to make economic sense at maturity. It says consider the mature case where 3% solo staking APY and 1.5% RPL value loss per year due to supply inflation. Using the same assumptions as earlier, this results in a 2.3% drop compared to solo staking rewards. In such case, there is no reason to make mini pools if you can afford solo validators. There's one simple problem that can be reduced is reduce the minimum staked RPL requirement. However, this solution would also reduce RPL to RETH TVL relationship per ideal 3, which means that the cost to avoiding this brittleness is letting go of a relationship that can be known ahead of time. The market has no way to signal that they're interested in RPL in Rocket Pool at minimum RPL stake set at 8%. Yeah, so the really interesting point here is making, right, is like right now people don't want to stake with 10% RPL. However, if we reduce that to 8%, maybe some people will come in line, but then even some people still won't want to stake at 8%. So then you reduce it to 6%, and even then some people won't want to stake with it at 6%. Then you reduce it to 4%. The idea is that you just don't know where that comfortable point is that people will want to stake with Rocket Pool at a certain percentage. So it just makes sense to break that relationship completely and set up a new relationship instead. And that's what we're actually going to get to in part 2. So it says there's no way, market has no way to signal that they're interested in Rocket Pool at minimum RPL stake, set at 8% borrowed ETH versus 10% borrowed ETH. All we see is that the market simply stops making mini pools or even starts exiting them when the overall package is seen as unattractive. We might already be seeing this happen today, as shown by the supply of node operator ETH in figure 2 below. So here you can see that Rocket Pool's node operator ETH has peaked. We had a huge period of growth going all the way up to the Atlas launch and that period around it. And since then we've plateaued and actually gone down. And if you look at the net flow of ETH coming into the protocol, you'll see that it's been going down. It had consistently periods of up, and then recently it's had a lot more down periods than up periods. So this shows that Rocket Pool's tokenomics, the way the protocol is set up right now, is broken, and this isn't good. So what happens now, right? Let's go to section 2, and this is the introduction to the tokenomics rework. So this is items that directly address the tokenomics issues. So it says, with the rework, speculation and node operation are separated. It becomes possible to run a Rocket Pool node with only an ETH bond. So that idea of needing RPL and ETH together, that relationship is broken completely. But the key thing to understand here is that, RPL isn't left adrift. RPL is still going to be used as the central component of the protocol, and having value capture mechanisms, which are vital and fundamental, of course. So here they're going to say, for the variants of the rework that introduce RPL buy and burn, or RPL buy and liquidity provide, it may be sensible to hold RPL as a standalone investment at protocol maturity. So what's happening now is, currently people who hold RPL are two kinds. There are those who use it to stake, and then there's those who use it to speculate. But they're speculating basically based on how the stake will change and how the stake will grow. With these new mechanisms, it could reach the point where people will actually want to hold RPL because of its own fundamental value that it has, which is actually pretty exciting. So it says staking RPL alongside ETH bond still has value. Those are the people who will vote on the protocol, and they'll get a share of the protocol revenue for that. It says then, with the rework, we do not impose a value onto the market. So node operators can freely value providing an RPL stake alongside the ETH bond. So the idea that, we're trying to force this onto the market completely goes away. There will be no pressure on node operators to hold RPL. However, it will be in their financial interest to hold RPL, which is pretty cool. And then another thing as well is people can bring as much RPL as they want. So there will be no minimum stake amount. You can set up an ETH validator and just have 10 RPL or have 100 RPL. There is an upper limit, however, which will be 150% of your bonded ETH, just like we have now. And the impact of that will be slightly different from what we have right now under RPIP 30, where there's a curve. It'll actually become linear again. So that is actually really exciting that, there'll be that possibility for node operators again. And then there's some items here to think of, like what's going to happen. So it says items addressing other issues. With the rework, smaller ETH bonds will be possible. This dramatically increases capital efficiency. Arguably, this is the most important single item in the rework. While other changes impact how the revenue is distributed, this change increases how much revenue each unit of capital can generate. So this is actually really amazing because, with the original 16 ETH validators, each ETH that the node operator brought could only provide 1 ETH of our ETH. With 8 ETH validators, it became 1 ETH to 24 ETH. With not 24 ETH, 1 ETH to 3 ETH. With 4 ETH validators, it will become 1 ETH to 7 ETH, and then with 1.5 ETH validators, it'll actually become 1 ETH to like 24 ETH or something like that, like some amazing amount. With the rewards as well, like people will be getting much better rewards. So if you have an 8 ETH validator, you'll be getting a 10.5% boost according to solo staking. With a 4 ETH validator, which is where we're going to start, that will be 24.5% boost to solo staking. And then with a 1.5 ETH validator, you'll be able to get a 71.2% boost according to solo staking, and that's at 3.5% commission from our ETH. So then they'll mention here, like briefly, like you have to remember this is the introductory document, that you'll get node level penalties and forced validator exits are needed to make those smaller ETH bonds safe, and mega pools will help a lot with providing node level punishment, and it'll also allow the costs for setting up and maintaining validators to be cheaper. And then the RPL inflation will be reduced from 5% to 1.5%, and because the current 3.5% that's going to node operators won't be needed anymore, so that will just be removed. And then there's forced delegate upgrades as well. With a grace period, will limit the technical debt of Rocket Pool accumulates from previous versions. So let's have a look at the tokenomics rework and actually dig into some of the details here now. So the first thing is like protocol revenue. So how is this going to work? The protocol, Rocket Pool, the protocol gets revenue from one way, rETH commission. So people mint rETH, they get staking rewards of that. Of those staking rewards, they give 14% of those rewards to node operators. Instead of giving that directly to node operators going forwards, that will be going to the protocol, and the protocol will be figuring out how to divide out that money that's coming in. So there's some explanations here of how things are working, but I'll explain it as we go along. So what's going to happen with that 14% is it's going to be divided out across 3 different areas. One of them will be going to ETH only validators. So these are people who don't want RPL, but they do want to stake with Rocket Pool. So this will be called the node operator commission share, and it'll be paid to all node operators, kind of like how they get ETH commission now, except it'll be without any dependencies on the RPL. There'll be no need for them to have any RPL. The second will be for people who stake ETH with RPL with that, and this will be called the voter share. So it says this share is collected from all validators and then distributed to participants based on their proportional share of vote eligible RPL. So if you stake RPL as a node operator, your RPL is eligible for voting. So you would receive proportional share from this pot of revenue. Importantly, this revenue grows with rETH TVL, where growth would allow for the same supply of vote eligible RPL to earn more ETH. And then finally, there'll be a third section called surplus share. And this is value that is going to people who hold RPL the token. And this will be the amount that's left over from that 14% after it gets given to node operators and voters. And this is one of the areas, the few areas in the research where we still have some question marks that we're still figuring out, is like what will happen with this surplus share. The idea is that it'll be some kind of buyback and burn. So there'll be ETH that'll be in the surplus that will be used to buy RPL, and the RPL will be destroyed. So what happens is, the token should become more valuable. There's also some other ideas of how to use this, but we'll talk about that below. So here, what's important to know is like you can benefit from the protocol in different ways. So if you are just an ETH holder, just an ETH staker, then you'll only benefit from the protocol by getting the ETH commission. If you are just an RPL holder, then you'll benefit from the protocol by getting value from the surplus share. And if you are an ETH and RPL staker, then you'll get benefit across all 3 of those different categories. So you'll be getting all of that 14% value coming to you. Now, the way that the numbers are broken down is it looks like initially we will have 3.5% of the rewards coming into from our ETH going to node operators. We'll have 5% going to the voter share, and 5.5% will be going to the surplus share. So those are how the numbers are broken down. This is then they're just kind of explaining how that works. So from the node operator perspective, you'll actually, if you have a look at the current LEB8 allocation, you need to bring 10.4 ETH, and total node operator capital after 1 year will be 10.894 ETH, and that's provided that the RPL value of course stays the same. It says the node operator earns APY on their bond, a 14% commission, and the result, basically, let's have a look. The result is that you get 1.14 times solo staking APY. So it says at maturity, RPL will approach 100% staked, which means that the RPL rewards become like insignificant because your inflation is being cancelled out with your stake. So that will result in a 1.1 times solo staking APY, which of course is not very attractive. Then if you're using 8 ETH validator and just have ETH only validators, then you will have, at the end of 1 year, you will have 8.369 ETH, which shows that you'll have an 11% increase, or 1.11 times solo staking APY, but then there's no dependencies on RPL or anything like that. So even though the rewards might sound like they're a bit smaller, from 1.14 times to 1.11 times, you have to remember that these are the 8 ETH validators, and that's not really what we will be going forward with. It'll be the 4 ETH ones that are much more attractive. So then there's information here as well of what will happen. Proposal using the current minimum LEB8 allocation. So if we use the new tokenomics system with the LEB8s as we have them now, where you need RPL and ETH together, the way that it works is, this is, for example, if you, let me just take this a little bit step by step. So it says this is with the minimum LEB8 allocation Sankey. So you start with 10.4 and then you end up with 10.816. So they say the node operator earns solo APY on their bond, 3.5 commission from the borrowed ETH, 5% revenue share on their vote eligible RPL, and 5.5% share on the RPL. Meanwhile, they lose RPL value, inflation going to the ODAO expenses. This is the end result is the node operator would make 0.96 times solo staking APY. And note that the voter share depends on your exposure to RPL relative to other node operators. E.g., if half the validators are ETH only and half look like this, the node operator, the voter share going to this node operator would double. That would result in the 1.007 times solo staking APY. And this dynamic will be explored in the case study below. So you might think, why would I do this, right? Like, why would I be happy with the new system if I'm going to be making less than solo staking right now with this? Well, the thing to understand is, first of all, that a lot of people will be staking. Let's have a look at the case study. So the case study says, in the study we have 3 node operators, A, B, and C. So A has 8 ETH validator and no RPL. B has 8 ETH and 6 ETH worth of RPL staked, and C has 8 ETH and 15 ETH worth of RPL staked. There's note the vote eligible RPL is capped at 150% of bonded ETH. This leads to node operator C earning twice as much from the voting share. So node operator A would get 0.035 ETH, node operator B would get 0.085 ETH, and node operator C would get 0.135 ETH in this example, which is pretty cool. But then if we get even more, 9 more ETH only validators join, what ends up happening is the ETH only validators end up getting the same amount, 0.035. However, the vote share will end up getting 0.0235 and 0.435. So their amounts will go up a lot. So there'll be a lot of preference, basically, a lot of incentives to stake RPL with your ETH. So what happens is the people who stake ETH only validators, they will be kind of paying out the people who are staking with RPL. And these numbers get much more, like, we're going to look at it at the lower bonds next. So it says, now we can see that 9 more node operators identical to A join. As you can see, there's a self-balancing effect. Voter share value paid to node operator B and C increases 4x, even though they have the same RPL. Surplus share value has grown 4x over the same supply of RPL. In short, node operators unwilling to take RPL exposure still grow the protocol's ability to meet our ETH demand, and higher our ETH TVL makes RPL exposure more attractive. So that is like a really important part of this whole tokenomics rework, is that as more node operators come on with only ETH, it actually becomes a huge bonus for people who are staking RPL as well. So next, when we have a look at the lower bonds, this is where things are really great. So it says, zooming all the way out, the total revenue is our ETH commission times our ETH TVL and validators. To get a return on interest, return on investment, we divide a total investment, which is bonded ETH plus RPL market cap in ETH. From this, we can see there are 4 ways for total return on investment to improve if all else is held equal. So increase the R ETH commission, increase the R ETH TVL, less bonded ETH, and lower RPL market cap. So lower bonds are important because they are the only way to execute on 3 without decreasing our ETH TVL. In fact, lower bonds also help hit 2 by making it possible to service more RPL TVL given the same node operator investment. So if we have a look at, so Saturn is going to be broken up into 2 parts, Saturn 1 and Saturn 2. And with Saturn 1, it says zoom into a single operator. The easiest way to look at the impact of lower bonds is by considering ETH only validators and looking at their return of investment. as we can see, we get dramatically higher returns of investment for the same commission, or equivalently, we can get the same return on investment with dramatically lower commission. The takeaway is simple from a capital efficiency point of view. Smaller bonds are better. So in Saturn 1, we'll be having the 4 ETH bonds, and that will have 24.5 times, 1.245 times solo staking rewards. And then like that's going to be the sweet spot where we're going to start the protocol. With Saturn 2, however, that's where we get mega pools and the bonding curves, where you can have the 1.5 ETH validators. This is despite the smaller is better takeaway from above, there are real limits. Security requires us to have enough bonds per validator to align incentives and mitigate damage in case of slashing, abandonment, and MEV theft. The result is a proposal that starts out with 4 ETH validators for the first 2 validators. After that, you can have as many validators as you want at 1.5 ETH. It says we can see that return on investment improves rapidly as node operators add validators. And then they start to flatten out. Note that this proposal requires forced exits to be available for security, which cannot be implemented until Saturn 2. So here, if we take that same 3.5% commission, you'll see that you're heading towards 1.7x of solo staking rewards, which is absolutely amazing. So now, how can we balance all this, right? Like, what if people still aren't happy with the RETH commission? Like, okay, what if the node operator rewards aren't enough to get new node operators coming online? Or what if the RETH commission is too high to be able to lift the amount of RETH that we'll need to get all these like benefits? Or what if we're like burning too much RPL for it to be basically, like, what if we're burning too much RPL? So this is where the UARS, which is the Universal Adjustable Revenue Split, comes into it, and listening to the market. So with the current state, there's no listening to the market, right? You have fixed commission, it's 14%, and that's always going to be there. And there's a fixed protocol fee, which means that the 10% of the RPL that you need per validator is fixed. There's no listening to making tweaks as you need to. However, with the new proposal, we have this new UARS, like I said, Universal Adjustable Revenue Split. And this is actually really, really interesting because those 3 components, we can tweak all of them depending on what is going on with the protocol. So with node operator share, if we don't have enough node operators, we can switch that, the 14% commission we can give a bigger share of that to the node operators. So we're attracting more node operators to come online. With the voter share, it says consider voter share as a requirement to function. If there is not enough eligible staked RPL, then the protocol can be at risk of governance attacks. There is a method specifies that balance voter share with surplus share to ensure 60% of all RPL is eligible to vote. So this is an idea basically of making sure that you give more rewards to the people who are voting, and then they'll be more enticed to stake their RPL with their ETH, because you'll just make it so much more profitable for them. You'll actually make it so it's they'll want to do that. That's a nice target there. And then with the surplus share, this is really interesting because what you can do here is you can make the surplus share. It says finally consider the surplus share. RPL holders are incentivized to maximize something along the lines of surplus share times RETVL. This means voters generally have an incentive to balance high surplus share with making RETH holding attractive. So the surplus share, what we can do is we can change the surplus share to make it so the RETH is becoming more attractive. So instead of having 5.5% of surplus share, we could reduce that to 3.5% surplus share, and instead that extra 2% can go back to RETH holders, and their commission could just be 12% instead of being 14%, if we're finding that not enough people are minting RETH. So there's some really, really interesting like dynamics that you can tweak here. So listening to the market, what happens is that you can actually now really understand what's happening with the market and adjust the protocol in such a way that we can maximize what we need and minimize what we don't need. So one of the reasons why the commission to the validators is the node operator share is 3.5 instead of higher is because we think that this will be attractive enough to keep all the validators we already have in the protocol and bring on new validators without needing to overpay them. Like if we were paying 7% of the 14%, half of it to the node operators, they would be getting like way more than 2 times solo staking rewards but that in a sense would be too attractive, and it just wouldn't be necessary really. Then with the RPL value capture options, this is for the surplus ETH. Like, where does it go, right? What happens to it? How do we give value to RPL? Well, there's 3 different ideas right now that we're kind of trying to figure out, and this is one of the areas where there's still discussion taking place. So if you have ideas and perspectives, please get involved and share those. So the main one is, it says, ideally the preferred implementation can still make it to Saturn 1. If not, it'll be in Saturn 2. In such case, the revenue during Saturn 1 period will be allowed to build up and then get distributed over a bit of time once Saturn 2 is live. So the surplus share, depending on, if we can get one of these mechanisms into place before in Saturn 1, then we can start the surplus share right then. If not, we'll just let the surplus share build up, and then we can decide what we do with it in Saturn 2 when we have the mechanisms in place. So the 3 main options that we have so far is buy and burn. So this is like, every X period amount of time, the ETH that the protocol has is used to buy RPL on the market and then just burn that RPL. So it says the implementation uses a time average market price and avoids large steps in available burn liquidity to limit opportunities for someone to game the system and steal value. With buy and LP, this is, I think, one of the interesting ideas. It says to buy an LP, ETH revenue is used for a single-sided deposit into an RPL or ETH liquidity pool. Note that single-sided deposit is equivalent to an RPL buy followed by an asset-weighted deposit. So that's actually really interesting. And it says the liquidity pool is weighted pool with 90% RPL weight and 10% RETH weight. This means that 90% of revenue would be going to drive value directly to RPL, and 10% would be going up to build deep protocol-owned liquidity for RPL. The other 2 options do not build liquidity. This means that the PDAO would need to fund liquidity in some other way, like through the IMC, or not have that much. It says, unlike buy and burn, there's no time averaging on price is possible since the liquidity pool is a live market. As a result, the implementation will need to take even more care to avoid large steps. Now, this is my own opinion. Like, I've not shared too much opinion so far, but I think I'm growing ever more in favor of the buy and LP option. And then finally, the voter share is basically just make it so there's no surplus share, and instead all of that value goes to the voter share, which goes to people who are staking RPL with their ETH. So this means that node operators are natively able to benefit from RPL's value capture directly. This has some positives as it directs ETH received instead of indirect value capture. It leads to some complexity in implementation in one of the above options, and some negatives, such as a much smaller total addressable market. Note that it becomes possible for non-node operators to benefit via abstractions, and that's, for example, is node sets proposed XRPL. And that would kind of bring it most in line with what we have right now. So yeah, next is supporting components of the tokenomics work. So this is part 4. So these are all the different things that will need to go into the tokenomics to get it all working the way that we want. So one of the things that will happen is that there'll be anti-sock puppet effects. So right now, if you have 100 RPL staked, let's just say, all on one validator, you get half square root worth of votes. So you'll get 5 votes based on that. However, if you had 10 validators with 10 RPL each, you'd get half square root of that, which would be around 15 votes in governance instead. Now, the reason for that is because each validator is, the 16 or 8 ETH. They're all the same. There's no benefit for you to have more validators on one node. Whereas with the new system, what will happen is, because the first validator will be, first 2 validators will be 4 ETH, and after that 1.5 ETH, you actually have an incentive to put more of your ETH onto one validator, and then you're not sock puppeting, you're not attacking governance in that way, which is really cool. Mega pools is what Kane is working on. So this will be one smart contract for all of your validators instead of each one having its own smart contract. The benefit of this will be that gas will be a lot cheaper, and it'll be a lot easier to manage a node level a collateral instead of like a validator level collateral like we have now. So that's really cool. Forced exits, of course, comes from the Ethereum protocol itself. That means if there's any validator for some reason who's not doing what they're supposed to be doing, then you can remove them from the network to lead to a healthier network overall. And then you also have node level penalties, which means that for example, if the lowest collateral you can have safely is 8 ETH, like we do now, because of MEV theft, etc., or slashing, then because you'll have all the validators at the node level instead of at the validator level, what that means is like, you can have, as long as you have a minimum of 8 ETH, then you're protected against MEV. Then after that, you just have to worry about protecting against slashing. And that's where those 1.5 ETH validators come in from, because they also protect against inactivity leak to some extent. So those are the things that I think will really help Rocket Pool as well. And I think it's gonna work really nicely. So with that, then we have forced upgrades, and this will be to remove technical debt. It means that if you are on an older system, you'll have to eventually upgrade to the newer Saturn validators. And then there's an express queue as well, because we expect there to be churn, people having to exit their validators and come back online as mega pools. What we think will happen is we're going to come up with systems to make that more beneficial for everyone involved. And then finally, part 5 is the glossary of terms. So there's just some of the terms that are used in the tokenomics work, and it just explains what those means. Things like bonded ETH, borrowed ETH, cliff, forced validator exit, LEB or XETH bond, mega pools, MEV theft, node level penalties, node operator, top off, RETH TVL, and solo staking APY. So I'm not going to explain those because I think most of you guys already know what those things mean. But if you want, you can just go to part 5 of the tokenomics to read what all that means. So that's where we stand with the public explainer. So now let's have a look at what happened. So I put out a tweet yesterday, kind of explaining basically what I just showed you all for the last 40 minutes. I put a tweet there yesterday that summarized all 5 of those parts, and it got a lot of positive feedback, like 131 likes, 48 retweets, and a whole lot of comments, 16 comments of people like talking about why they think this is positive, why they think it's negative, but mostly the comments are positive. I also put the same thread on Reddit's ETH Finance page, and here it was one of the most upvoted posts of the day. So it's got 59 upvotes, and it also spurred a lot of discussion as well, mostly positive, some of it negative. One of the people was saying like that. Well, one of the actual interesting feedback was about the charging RETH holders 14%, and this person saying that about how it was going to limit growth for Rocket Pool by charging higher than like Lido and others amounts. And then there was some negative comments as well about people saying that having the RPL token at all is extractive, etc. But that was rebuked quite well. So this person, he said, I'm disappointed. I hope that RPL would disappear completely, and instead you would have, for example, taken a 10% fee on my earnings to finance your DAO. 10% looks very generous to me. It says this way I would earn 32% more than with solo staking. Your approach is so bad in comparison. If I understand it, I would earn 10% more with solo staking. And your new system seems to be designed by RPL holders for themselves to pump their bags, not for newcomers that you would need to grow the network. And then Val actually had a really interesting response here, saying, I wouldn't suggest focusing on exact numbers too much, and way more diplomatic than I was. So that's cool. But yeah, there was a lot of love for this post on ETH Finance as well. So people, it seems, are really excited about the new tokenomics. In the Discord here, Samus had some interesting points about what happens next. He says, well, for the tokenomics, he says the 2 main goals is, do people understand the tokenomics rework and how do they feel about it? So that's the things that we're trying to do, and get the information out there so more people can understand what's happening, and then trying to get feedback. How do people actually feel about this? Because I'm not sure if we want to include an informal poll, and that's the polling stuff that we already talked about earlier. And then we talked to Samus about timeline, and that's okay. So sorry. But it seems like Samus's timeline was a little bit more optimistic than Val's. According to Val, Samus said that we would basically spend the next few weeks like discussing it, getting ideas, and then potentially moving to a vote in about a month. Val said that he expects it to take a little bit longer, but basically that's what it looks like where we're at right now. Actually, if we go back here, there's the where we're at. So there's rough steps here. So yeah, so here there's the estimated progress. You can see it just at the top of your screen. So, complete the first draft of the full proposal specifications. That's done. Seek feedback from technically skilled or highly engaged community members. That's where we are now. create high-level explanations. That's done. And make a concerted effort to gather feedback via the forum. So that's what we're doing now as well. Next is update the proposal and specifications as needed to take account of wider community feedback. Run a forum temperature check for the full vote. So it looks like we'll have like 2 weeks maybe of discussion, 2 or 3 weeks of discussion. Then we'll make an update to the documents and give people a chance to engage with those ideas. At which point then we will run a temperature check on the full proposal, bar the value capture mechanism. So that it looks like might have to wait because the team are getting some legal advice and we still haven't figured out what the best way to go forward is. Of course, that will have to wait till Saturn 2 anyway. So that's not as rushed necessarily. Then we run a snapshot vote on the full proposal, bar the value capture mechanism. Then run a snapshot vote on the value capture mechanism once outstanding blockers are cleared, and then update the proposal to incorporate the value capture mechanism result. So it looks like, we've got another couple of months for this whole process ahead, potentially longer depending on the value capture mechanism stuff, but it's looking really exciting. So yeah, I'm really excited. I have to be honest, right? Like this whole process has been amazing. I know it's taken longer than we would have wanted. Like it started in November, and only now are we getting to this point where we can present this to the wider world. But there's really, really great work going into here. Like Jasper said on Twitter a few days ago, like we've spent, multiple years thinking about these ideas, and this is the culmination of like all the positives that have come from that thinking. And I really think that Rocket Pool, because of this, will be a brand new protocol by the time these updates go live. And I'm so excited about the consequences of it. Like I really feel like Rocket Pool will be able to like thrive and really grow because of this. So it's pretty amazing. Okay, so last night was rewards night, and with the rewards night, we actually got a new ratio locked in. So the ratio locked in was 0.00555512. And this meant, of course, that some people were under collateralized on their validators, so they had about 10 hours basically to add more collateral to their validators. Now, something really interesting happened yesterday as well is that the ratio during earlier on in the day and the day before was around 0.0052, which was a new low on the cycle that we hit. However, it looks like we bounced quite nicely since then, and I'll talk about that a little bit later. But Jasper here had some like literal astrology stuff going on, which is kind of funny. He said today the Rocket Pool initial tokenomics rework outline was made public for broad feedback. Today was also RPL reward snapshot. Nodes must post 10% collateral to earn RPL rewards. The official price was 0.00555. The ratio having the 555 angel number is fitting. This checkpoint sync system will soon be a relic. With the new tokenomics, the days of tracking the ratio will be gone. 555 signifies change and transformation. It takes strength to look at your flaws and grow, but it's a sign of life well lived. Rocket Pool has stared long and hard in the mirror, and now it's time to prove it's a DAO still living. So that's for Pteris. Just for you, Pteris, I'm covering the 555 stuff. I know you really love that. When it came to the actual rewards night, though, there were some issues with it. It seems like some of the rewards trees weren't being submitted properly. Ramana said, this is coming through as link spam. And how do I get my rewards? And what's going on? So they were waiting for the official trees to be uploaded to GitHub, and that wasn't working very well. And then a few hours later, Langers had an update saying that for anyone waiting on the rewards trees, they're now available. So this was at 6:40 a.m. So it was a while later that the results came through. Still waiting to figure out what happened with that. I'm not exactly sure. But as soon as I get information, I'll probably cover that in tomorrow's episode for you all. Also, D. McCartney here said that he's got an update cooking for the Rocket Sweep website, saying I've got an update for the tooltip to make it a little bit more helpful when deciding when and how much to top off. Before, after RPL shows shortage and trims other noise. So you can see here that it'll tell you like how much above or below threshold you are, and what you need to top up, or where the ratio needs to be for you to top up. So that is a nice little addition. And then this was an idea that I had yesterday after looking at how the price changed during the day and how the sentiment changed because of the tokenomics work. I said I was just thinking that we might have hit the rewards night ratio all-time low today. Of course, if that's if some of the hype things around Houston go as expected. With that, we should have a nice pump that leads to node set, which might boost RPL a bit more, and then the two Saturns will change rocket pool completely, and the rewards night ratio won't be a thing anymore. So the idea is, of course, that Saturn goes live in 11 days, and that means that the ratio that we had for yesterday's rewards night 555 will hopefully mark the bottom, as we'll get a pump from Saturn, from Houston, and then from node set, and then leading into Saturn. So maybe it's just a little bit of wishful thinking on my part that we've hit bottom, but that is just the way that I was seeing it. So hopefully that's how it plays out. Okay, next we've got a Treasury update from Vaca. Vaca says that this is the Treasury for May 9th to June 6th. And he says, if you need an intro to how the Treasury works, there's a post there. It says this period, the PDAO received 6,149 RPL from inflation. Its balance is now 53,959 RPL. The IMC and GMC were paid 10,423 RPL and 4,273 RPL respectively. So the first amount, the 6,149 RPL, is like for the protocol's rainy day fund, which we just put aside for the PDAO every month. And then the IMC and the GMC get certain splits. So they get 10,400 and 4,200 each. And then the next rewards period, the inflation share will be increased to 28.5%. And this will be the final budget update according to the PDAO vote 1 year ago. So the vote to reduce the ODAO's income from 15% of inflation to 1.5% of inflation will be fully done in the next snapshot, which is absolutely amazing. And I feel like a lot of people don't give that whole process enough credit. That people voted for a 90% pay cut for themselves is absolutely wonderful to see that they did that. Okay, next we got some kind of scary news coming out of the community yesterday, and as it became more clear over the day. So this happened overnight, where a bunch of validators that belong to 1KX started exiting. Now 1KX, for those of you who don't know, is I think the third or fourth largest node operator on Rocket Pool, and them exiting validators was something quite scary for people, because there's this idea that we don't want our node operators to leave. A lot of node operators have left already. The amount of ETH that we have in the protocol has gone down. If 1KX starts leaving, that's going to be really scary. A little while later, they actually withdrew 86 or 81,000 RPL here. 81,744 RPL was withdrawn by 1KX as well. So then the panic kind of, I think, was low-key panic was kind of starting, but it's like, is this going to be market dumped? Like, is there ability to dump this and not nuke the ratio completely? Like, what's going on? Well, thankfully we got a message from a person from 1KX saying that so this is Diana B said, hi all, Diana from 1KX here. Wanted to address the current speculation around our position. We've had to move some things around, but we will restake our RPL soon. No intention to leave. It's great to be part of the Rocket Pool community. So I think that assuaged a lot of fears that people were having in that low-key panic. Basically, I think what's happening is that they're just distributing their ETH and RPL across multiple validators. They already have three nodes, I should say. And so they're going to maybe set up a new node and divide out their collateral a little bit, just to keep everything separate. And if there's slashing or anything that happens on one of them, not the whole thing is at risk. So, phew. Okay, we've got some news about client updates here. So a couple of days ago, we had a Geth update. So Peter Sillidy here says, don't freak out. So the first thing he says, heads up, we'll be issuing a hotfix release soon. The previous Geth release is nothing scary, but the discovery seems wonky in certain Dockers, IPv6 and IPv4 Linux combo setups. It seems to be a regression in how we compared IPs versus how Go sometimes represents them. So it says, can't really say what OS runtime combo causes IP4 addresses to be wrapped in IPv6 with Go. I don't care much to figure out right now. So can't really say exactly what environments this presents itself, but we have a fix on the way and we'll push a release soonish. So I think, yeah, don't freak out. There's nothing at risk. There's nothing like to be scared of. But Geth will have a new version out soon. And then Nethermind have news of an update that's coming. So it says Nethermind 1.25 was fast, but the upcoming Nethermind 1.27 is 3.7 times faster on your existing hardware. So improved attestation rates for all. So this is actually really exciting that they've been able to like pump out such a huge performance increase in their hardware. It's just astounding. Like, so for version 1.25, it looks like they had around 80 megagas per second capability, and then with 1.26 it went up to 100, and now it's going up to like 250 basically, which is absolutely amazing. So Nethermind is really pushing the limits. Nethermind have actually been doing a lot of stuff with Coinbase's base, and what they're doing there is they're trying to work on getting that 1 gigagas per second throughput on their client. So Nethermind is definitely pushing the limits. So I think this update will be available soon for rocket poolers. So if you're using Nethermind, hopefully you should see much better performance on your client. Okay, moving on to some wider staking news now. Here we have an update from Etherfi, and Etherfi have to get a huge shout out for this. They're doing something really cool. So they said the Etherfi Foundation will be sending 1% of the Etherfi token supply to the protocol guild. This will be 10 million token Etherfi tokens vesting over the next 4 years. This is one of our core principles, is to do the right thing for the Ethereum community. Always sending our token to the protocol guild ensures long-term success of the network. We hope others will follow suit. For those of you not read of our principles, we have them below, and we've been following these since day one. So this is actually really, really awesome to see that Etherfi are going to be donating. I think their token is like $3 or $4. So, up to 30 or $40 million they're donating to the protocol guild over the next 4 years through their vesting. So that was wonderful. Like, huge shout out to Etherfi for that. I'm a huge supporter of the protocol guild. The protocol guild is a collection of like 170 protocol developers, and they basically get funding through so protocol guild is a collective funding mechanism for 170 plus Ethereum layer 1 researchers and development maintainers stewarding our commons infrastructure. So they'll be getting a nice amount of money coming in for the next few years from Etherfi. Of course, Tyco did this recently, so huge shout out to these groups. Okay, I've had some issues with my browser on Discord today, so sorry about that. Let me just fix it up. Okay, yes, excellent. So next is some Ethereum news, and I'm going to start with Gravita here because, of course, lots of rocket poolers have used Gravita. So Mage Style, who's in one of the Gravita community people, no, not one of the Gravita team people, said, we decided to reward all Ascend participants regardless of their usage of the bridge. Layer 0 agreed to this, which I think is quite incredible of them. So let me explain what's happening here. So Layer 0 is a bridge that's doing a huge hyped airdrop, and a whole lot of people are excited about getting this token. And what happened is that Gravita users were going to be eligible for getting this airdrop. Now what happened is that they have decided to give rewards to all Gravita users instead of just the ones who interacted with the bridge. So if you are on Gravita, if you have used Gravita, then you will be getting a share of this airdrop. Now there is this Google Doc, a Google Sheet, that tells you all the different eligible addresses and what percentage of the allocation they'll be getting. So there are like some whales here who will be getting like 1% of the allocation, but in total they have 5,040 addresses, and they will be getting everywhere from 1% of the allocation all the way down to 0.00026% of the allocation. So the number of tokens, I guess, will be is yet to be decided, but I think it's linear airdrop based on your Gravita Ascent points. The more points you have, the bigger the airdrop you will get. So that is actually really nice to see. I'm not sure when that will happen, but hopefully, I think the Layer 0 are going to have their token generation event this month. So you can expect, some tokens from Layer 0 to come to you because of Gravita. Okay, this is following up with the story that I covered while, Anthony was away and I was covering Ethereum news. Well, Coinbase's smart wallet is out today. So if you were waiting for this, you now have access to the Coinbase smart wallet. It's literally like so easy to use. You press a button, create wallet, it does a Face ID, and that's all that happens. There's no management of seed phrases. There's no management of anything else. It goes onto the secure enclave onto your phone, and you get simplified gas fees and transactions, and you can connect to Coinbase wallet. So the Coinbase balance will be linked to your Coinbase wallet. So you can have the crypto on the exchange, but you can also interact with it through the wallet on apps. So this is actually going to be, I think, really, really useful for the Coinbase users. And I guess crypto users who want to interact with it this way as well. So congratulations to Coinbase for getting this out. There's a whole lot of hype around this wallet. So it's going to be really interesting to see people's feedback about it. I think the idea is like if you're using MetaMask, it's going to be a huge upgrade for you. But if you're using something like Rabi or Rainbow Wallet, it might not be that much of an improvement for you. I'm not sure exactly how it's going to work. I'll probably start using it at some point in the next few days just to play around with it a little bit. But I think that's really cool. Okay, next we've got some news of the SEC losing in court again. So here, Austin Campbell says, this is the point I've been making for a while about the current SEC. The problem is not unique to crypto and is going to have severe implications for overall markets and regulatory regulatory credibility if the SEC continues with illegal conduct. And here there's the ex-lawyer says, the SEC lost in court again. This time the SEC created a rule requiring private fund investors to provide quarterly statements and undertake other disclosures. The problem, there was already law passed in Congress that specifically addressed the reporting and other legal requirements of private fund investors. And how much did the SEC estimate this new rule would cost to implement? To $5 billion per year. Ultimately, the Fifth Circuit concluded the SEC has exceeded its statutory authority and adopting the final rule. Get used to those words. The SEC has exceeded its statutory authority. We're going to be seeing that a lot. And this is the case of National Association of Private Fund Managers versus the SEC. So it's not crypto related, but it just shows that the SEC is just doing dumb stuff all over the place, and they're getting called out in court from it. And hopefully this will help when those crypto cases come to court as well. And finally, there's news of Robinhood buying Bitstamp, the exchange. So Robinhood saying they're buying Bitstamp. So I think they're paying $200 million for this, which people seem to think is actually a steal. It's a really good deal for them. And it seems like they are integrating the crypto stack into their business more and more, which is amazing to see, you know, these TradFi companies and like modern new TradFi companies really embracing crypto. So on that note, this episode has gone to an hour, which most of it was spent, of course, talking about the new tokenomics. But hopefully you all like got a lot of information out of the tokenomics section. If you still have questions, you're welcome to try to ask me. I'll try my best to answer them. Or you can pop into the Discord and ask Val, Samus, Long for Wisdom, etc. in the Discord or on the Rocket Pool forum as well. You can ask your questions now and get that information out. But this is amazing stuff. It's like really, really cool. And I'm really excited to see what comes from it all. So on that note, on this really happy note, I'm going to end today's episode. So thank you all for watching, listening, and being part of the Rocket Fuel community. And I will see you all tomorrow. Bye.